Hello everyone, welcome back to my channel. In this video, I'm going to explain to you how to trade the MMXM next day model. I'm going to show you my version of it. So I have added some tweaks to it and I have made it around 90% mechanical. I will share with you the full simplified plan with all the steps that you need to follow to form a trade idea and execute. This model is one of the highest probable models out there. The frequency of the setups are low, but the win rate is pretty high. You can add it to your arsenal or you can make it your main model and trade multiple pairs using it for a respectable number of trades per month. So let's talk about the structure of this video. First of all, I'm going to give you the full trading plan, so all the rules it contains, and I'm going to explain them to you one by one with the help of a diagram or a drawing of how the model looks like. After that, I'm going to show you many examples of real charts so you can understand how to apply the model properly. And sometime later this week, I'm going to do another video backtesting this model. And now, let's just get started. Now, before we start, I want to give credit to the MMXM Trader. Shout out to your brother. I'm going to link his Twitter account down in the description. If you don't follow him, go follow him and study his charts. They are pretty valuable. And now, let's just get started with the trading plan. So, the next day model trading plan. Let me pull out the first condition or rule, right? So, step 1. And let me pull up also the diagram. Good. The first rule is you need to identify a daily swing formation inside a PD array. Focus, guys. A daily swing, daily is the keyword. So we are operating on the daily time frame only. Swing formation inside a PD array. A swing formation, daily swing formation is something like this. You have a candle on the middle. So it is basically 3 candles formation. You have a candle on the middle. The candle on the left is higher than this one. And the candle on the right is higher than the middle one. So this is a swing formation. And you need to identify this swing on the daily, meaning the daily time frame. Now, this swing, right, this swing formation needs to happen inside a PD array. A PD array can be fair value gap, it can be an order block, a rejection block, a swing, so it can also be another swing, something like this, right? So a swing right here, or it can be a swing high, right? So it is also a PD array. It can also be a breaker block. There are other PD arrays, but these one are the common. Now let's take a bullish example. Price is trading lower. It hits a PD array, and let's suppose that PD array is a fair value gap. Now inside that PD array, it formed this swing right here. So what do we mean by inside? Inside, it can happen like this. This is inside. All right. This is inside, inside. This is also inside. This is not valid. So valid, valid, not valid. If it's an order block, this is not valid. If it's a fair value gap, this is absolutely valid, right? If it's an order block, so basically we cannot trade below that order block. All right. So that's what we mean by inside a PD array. So this is pretty simple for the first step. Let's move on to the second step. The second step is you need to identify an opposing target. I repeat, identify an opposing target. An opposing target meaning something here. This is the opposing target. The target can be an external range liquidity or it can be an internal range liquidity. So let me draw you an example right here. Let's start first with an external range liquidity target. So let's say on the daily time frame, and of course I forgot. So this fair value gap, this PD array, right? It can happen on the daily time frame. So let's take, for example, a fair value gap. That fair value gap can be a daily fair value gap, it can be a weekly fair value gap, or it can be a monthly fair value gap. So the PDRA can happen on the daily and above. The swing formation can happen only on the daily time frame. All right, so I forgot to mention that before. Let's continue with the second step. So target external range liquidity. Let me give you an example. Let's say we have an expansion higher that's on the daily or the weekly, it doesn't matter. And price started retracing, and it retraced to a fair value gap right here from that leg. Now, inside that fair value gap, we formed this formation right here, this 3 candle formation. Now, what is the target in this case? This high right here, right? This is logical. External range liquidity, this high. Why? Because after an expansion, we are expecting a pullback. And after a pullback, we are expecting another expansion. That expansion is going to expand to that high. So that is the target in the example of external range liquidity. Now, let me give you an example of internal range liquidity. So internal range liquidity can be something like this. Let's say that we took a high from here, right? So we took a high. So expanding higher, we took a high from here, a swing high, and we left a fair value gap right here. And after taking that high, we formed this swing formation, right? So this one should be higher, right? Because we are in a bearish example, and we have a fair value gap right here. So this is an internal range liquidity, and we have a target. Now, these two are not the only variants of external or internal range liquidity. Let's say, for example, external range liquidity can also be a filled swing. So let's say that this is an order block. Price is moving lower and we hit an order block right here. That order block, of course, can be on the daily time frame or the weekly or the monthly time frame. All right, so we hit and we formed a swing formation. First step is done. Second step, identify an opposing target. An opposing target can be also a filled swing, so in the form of low resistance liquidity. So this right here is a filled swing. This swing failed to take liquidity from this swing, and you know that above swing highs there is buy side liquidity. So we have buy side liquidity from here, and we also have buy side liquidity here. So we have a target to go to the upside. This is also a potential target, an opposing target. It can also be a fair value gap right here, for example, right? So the example I showed you right here is only one of many cases. It can be also like this, hitting a PDRA, left a fair value gap right here, right? So just to make things clear. Now let's move on to the third step. The third step is we are expecting the fourth candle or the day, which is the same because we are operating on the daily time frame, to be bullish or bearish. Either bullish or bearish, all right? So if price is going down, of course, and we form this swing right here, we are expecting the fourth candle right here to be a bullish candle. So something like this. We formed a daily swing inside a PDRA. We have a target, either external or internal range liquidity, filled swing or a fair value gap, right? Now the third step is not really a rule, it is a conclusion. We are concluding from these two that we are expecting the fourth candle to be a continuation, right? So you are approaching the next day or the fourth day to be bullish. For bearish example, just inverse this diagram. So this alone is very, very, very powerful because you have a high probability bias. You have a pretty good idea of where the next day or the day after this swing is going to head. You have a high probability that the next day is going to be a continuation. And that means that you can catch the daily range. You can catch the whole daily range. So this is not just a 2-hour trade or something like that, guys. You can literally catch the whole daily range. So if we summarize things up, these three steps, or the 2 steps right here, is to form the bias, is to know whether the next day is going to be bullish or bearish. And after finishing these 3 steps, and we have a pretty good idea of the next day whether it's going to be bearish or bullish, right? Now all we have to do is to execute. And let's move on to the 4th step. So the 4th step, you need to drop to the 15-minute or the 5-minute time frame. So we are talking about this day right here only. Forget about these 3 candles. Only focus on the 4th candle, which is the 4th day. Drop to the 15-minute or the 5-minute time frame. Wait for price to trade below the midnight open, right? New York time. So this is midnight, New York time. Make sure to set that up. And after that, look for displacements and change in the order flow. Your time window is 2 to 5 and 8 to 11. All right, let me show you how that looks like. So let's do this. So suppose that this is the midnight open. After midnight open, you want for price to trade lower. Again, you want for price to trade lower because you are expecting a bullish day, meaning you want to see a Judas swing to the downside. Again, this Judas swing, this fake move right here, can either balance an imbalance, right, or retrace to a PDRA from the previous day or the previous 2 days, so the price action from here. And this time frame here is the 5 or the 15-minute, and this is where discretion will come to play, right, because this is not 100% mechanical approach. So after the Judas swing to the downside, you wait for a change in the order flow. So basically something like this. The order flow is bearish. You want to see something like this. So this is a change in the order flow. And you want to take your entry somewhere around here. So after displacement, you can take your entry on the pullback. You can also enter on the second leg and respect the time windows. You want to enter from 2 to 5, so this is in the London kill zone, or you can also enter from 8 to 11. Now high probability setups will form inside the kill zone of London or early in New York. All right, that's high probability, and that means that you can easily catch the whole daily expansion right here. And now after finishing explaining the plan, I believe that now we should transition into real chart examples, and I'm going to show you how to apply this trading plan into the charts and how to look for setups. So the first example is from the GJ daily chart. So on this chart, I'm going to give you 2 examples. One of them has worked perfectly, so it followed our plan to the T. The second example on the same chart didn't work or didn't meet our conditions right here. So I'm not only showing you the examples that worked perfectly and followed our conditions, I'm also going to show you examples that didn't follow one of our conditions, so it failed. All right, so let's start with the first example. So first of all, we need to identify a daily swing formation inside a PDRA. Now, do we have that here? You can clearly see it on the middle of the chart. We have a fair value gap right here, and inside that fair value gap, we formed a daily swing. So we have a swing right here. We have a candle. The candle to the left of it is higher. The candle to the right of it is also higher. And it happened inside a gap. So this candle right here, forget about this one. This candle expanded higher. We have only buys right here. So this is buy side imbalance, sell side inefficiency. All right, so we have a gap right here. We have an inefficiency. And this swing happened inside that inefficiency of orders. So the first step is check. We have a daily swing formation inside the PD array. In our case, it is a fair value gap. Let's move on to the second step, which is identifying opposing targets. So do we have a target? Yes, we have this high right here. So I told you before, price moves from internal to external. We have an expansion higher. Pull back, target this higher right here. Just like this one. Expansion higher, pull back into a fair value gap, and this is target, right? Same here. We are expecting these highs to be taken after balancing this fair value gap. So second step is check. Now we are expecting the fourth candle to be bullish. In our case, we have a bullish example. So this one, 1, 2, 3. So this candle, we are expecting it to be a bullish candle. Now, we don't know that it's going to be for sure a bullish candle. So imagine that we don't have this candle right here. We only have the conclusion of the fourth candle to be bullish. Now, what we are going to do is we're going to drop to the 15 or the 5-minute time frame, and again wait for price to trade below the midnight open. All right, so let's draw a line right here on this candle. Let's go to the 5-minute time frame, and remember, put a line inside or at the midnight open, not at 5 p.m. midnight open New York time. It's gonna be this one right here. Perfect. So back to the trading plan. You want to wait for price to trade below the midnight open, and we have that exactly. So price after that trades below the midnight open, and what do we have? We took this liquidity from here, and this happened to be the Asian range low, right? So again, this Judas swing can retrace to a PDRA, or it can take liquidity. In our case, it took liquidity. In some cases, some high probable cases, it will trade this Judas swing. It will take both. It will take liquidity and retrace to a PDRA right here. So this is even better if we have the two. And after that, look for displacements and change in the order flow. So basically the order flow here is bearish. Let me draw that for you. We have a bearish order flow. We have a series of lower highs. And now what do we have? So do you consider this as a valid displacement and a break of structure? This one right here. Do you think that this displacement is valid and you can take an entry from here? Absolutely not. Why? I told you before in just my previous video, you will see this pattern happens all the time. You will see a displacement or an expansion lower or higher. Let's take in our example displacement lower. You will see a pullback, price surge continuing lower, and then one more time displacing higher, and you think that this is a break of structure, and you might think you want to enter from here to go buy and reverse order flow. And what happens next? Price immediately reverses to the downside. This pattern right here happens all the time. It happens all the time, every single day. And we have example just next to this one right here. So we have an expansion higher. Price is now trading lower, right? It starts trading higher, so continuing to the upside. And we have a break of structure. And you might think that you want to enter from here to target these lows, maybe, right? So you think that this is a break of structure. And what happens next? Price trading higher. One more time, a break of structure right here. Only to sweep liquidity and then price trading higher, guys. We have another one right here, expansion higher, pullback, a fake break of structure, and then the real move begins. So this one right here is not a valid displacement. You need to wait for this leg to get taken. So let's see. So let's see, we are talking about this leg right here. And we have price trades above this high. This is a sweep of liquidity. High probability sweep of liquidity. This is a high probability break of structure, and price would continue from here. Remember this. So this is not a real displacement. Again, price trading lower, and this is a real displacement. We took this high right here. This high is the high responsible for creating the low. So this is a real break of structure, and you want to enter on the pullback. You can enter on the 50%. I believe that's the optimal entry. You will not miss moves, and you will also get a decent RR. So you can either put your stop loss here or here, because this could be the low of the entire day. And now what you want to target, your first target should be the previous day high. So an example right here, we are trading the Judas swing. Your first target should be this high right here, because if we are expecting a bullish day, this high is going to get taken always. If we are bullish, this high is going to be taken for sure. 100% this high is going to be taken. So you don't want to close above the high, above the previous day high. You want to hold, all right? So you can push right here and hold for the whole dealing range. So as you can see, it was a bullish day, guys. So this is why I told you that this is not a 2RR model. You can trade and you can catch the whole dealing range. Now let's move on to another example that it is not valid. So another example which was just before this example, which is this one right here. So what do we have? We have an expansion higher, right? We lift a fair value gap. Excuse me. We lift a fair value gap right here. Price went to this fair value gap, and we also formed a swing formation right here. So let's go back to the trading plan. We have identified a daily swing formation inside a PD array. All right, that's good. We have that here. Identifying opposing target. It can be external or internal. Do we have an opposing target right here? So after this candle, do we have an opposing target that we can trade for? No, we do not have an opposing target. We do not have that. We have the opposite of that. We have a target that is below us. You want to target something above you, but we have a target below us, which is this inefficiency right here that has been lifted. So this is not a valid setup. The target has already been met. So this swing right here, the external liquidity, and we have a target below us. You want the target to be above you, something around here, not here, all right? So after that, what happened? Of course, a pullback, expansion, pullback. This is not valid. This is not a valid example. We have another example just here. So we have a daily fair value gap right here, right? Price rejects that fair value gap, and what do we have? We formed this swing right here inside that PD array, right? So 1, 2, 3, and we are expecting the fourth candle to be bearish, right? So what we're gonna do now is we're gonna zoom in into this candle and we're gonna look for the final step. So let's outline that midnight open again. And what do you want to do, or what do you want to see? Wait for price to trade above the midnight open. So we are in a bearish example. You want to see a price trades above the midnight open. So we have that here. We trade above the midnight open, taking all this liquidity, and I believe we tapped into a PD array on the hourly somewhere around here. And after that, we need to see displacements and change in the order flow. So trading higher, a break of structure. We took the low that created the high. So this is a valid break of structure. Do you want to enter from here? Yes, we are inside that time window, right? So this would be our entry, maybe this one on the breaker block. This is a high probability that this is going to be the high of the day. So you can catch the whole daily range. And as you can see, price just kept trading lower and lower and lower. Now we have an example that is not valid on the same chart. So let me remove all this. What do we have here? We have an expansion lower, right? We formed a daily swing or a daily formation swing inside a PD array, which is this daily fair value gap right here. We have 1, 2, 3, and we are expecting the next candle to be what? Bearish. All right, we are expecting this candle to be bearish. It is obviously not bearish, it is bullish, but let's follow our plan and look for this criteria right here. So let's put a line here, and we're gonna drop lower and see if we have that final criteria. So remember guys that we want to see price trace above the midnight open because we are bearish. Now, do we have that on the chart? Let's put this on the midnight open. All right, here. Now, do we have a trace? Did price trace above the midnight open? No. Price traded below the midnight open. So this is a very good indication that we are wrong on the bias, all right? That our bias is wrong. You can see that we also left this equal lows, right? We have these equal lows on the upside. So this is a high probability due to swing to the downside, and this is going to be a bullish day. And that is exactly what happened. This is a bullish day. So the final criteria didn't met. So I believe guys that we have come to the end of this video. I believe that the model is simple. All you need to do is to be patient and wait for these time frames or these conditions to align, right? One by one. And you need to watch multiple pairs, guys. Don't just zoom in and choose only one pair, because it's not going to give you that many setups per month. So choose at least 4 or 5 pairs. Now I believe that everything is clear. The next video, or the video after this one, is going to be about backtesting this model, all right? So you don't want to miss that one. So if you have any questions, please DM me in my Twitter account or leave a comment down below and I'll answer you as soon as I can. Happy trading and good luck.